All right, guys, so I'll give you a little background. Don't worry, I'll wait. I'll give you guys a little background. I used to do acquisition for Pintar, which is Kevin's company, in the wee years of the tight yields of investment in hedge funds. And that's how I got tied in with them. And then I ran into Kevin and Jeff at one of their investor market updates, and I sucked him into coming here for all of you. So now he's here. So
Thank you.
Why don't you tell him? Why don't you give him an idea of what you do now?
So I do investor relations at Pintar Investment Company. We're a private equity real estate investment company, and we've got a fund. So the unique thing about our investment company is we're made up of 90 or so limited partners. Everyone pools their money in. You own the real estate pro rata by the dollars that you put in. We distribute all of our profits every 90 days to our investors. And I got started because at Pintar, I invested in Pintar in 2012. A really good time to invest in real estate. And my background is medical device sales. I grew up in Florida. My dad was a property manager all over Southeast United States. I didn't want to go into real estate, and I went a different route, and now I'm back in real estate. So my dad's very happy, and we are too.
That's awesome.
So Pintar is a small real estate investment company. We don't do any development. We buy existing single-family homes. Okay. We have a portion of our capital that we put towards buy and hold, and we have a portion of our capital that we fix and flip homes. And we're doing, 60 homes a quarter that we flip. We've got 230 homes that we own for rent, and predominantly out here in the Inland Empire. And I was super happy to see Bev's presentation because her numbers, pricing, and data for income, home price appreciation, everything was spot on for us.
Thanks, Bev.
Thank you, Bev.
So the company's gone through a bit of an evolution even before you were there. You came in 2012?
Mm-hmm.
Okay, so I came in 2012, 13. Okay, can you kind of touch on, before we kind of get into what the structure's like now, what was happening with Colony and the different acquisition ways you were acquiring, and then the way the team changed over time?
So Jeff started the company in 2009, right outside, right on the edge of the GFC. And we were just primarily fixing and flipping, buying homes off the courthouse steps in Orange County predominantly. Doing that pretty well on a one-off deal, and we started getting successful and thought to aggregate capital into a fund type situation where we could have partners. Instead of one by one on a project deal, we could have partners and distribute profits, mitigate our risk, spread it out over multiple homes instead of, again, one by one. Around 2012, 13, Colony and Goldman Sachs and KKR Beazer knocked on our door and asked us to be the operating partners for them. So we started buying single-family homes one by one in Southern California for them. We were their operating partners. And so it was a programmatic relationship, and what that did for us is it allowed us to scale the operation, because now we can do, and we did, everything for them, soup to nuts. So we analyzed it, bought it, rehabbed it, construction, maintenance, property management, everything. To the tune of 5,000 homes plus, and well over $1 billion invested in Southern California.
So crazy.
Yeah, it is crazy. And so that scale of operation allows us to give this sort of institutional type investment to our investors, because in 2013, 14, we started buying, well, 2012, we started buying the rentals side by side with them. But when Goldman Sachs and Colony American Homes is giving you 20, 30, 40 million dollars, you can't really raise your own money at that time. When they make a phone call, you got to pick it up. And if it rings 3 times, they get really, really pissed. So we kind of halted the fundraising for ourselves and focused primarily on them. That was a bummer for me as an investor. In 2012, when we owned 13 homes for rent, now we own 230. And that's really due to the experience that we learned and gained from working with Colony and Goldman and Beazer.
Trial by fire.
Big time. And you learn, and so we paid a lot of dumb tax over those years, and thousands of homes and hundreds of millions of dollars invested. But we're now, an institutional type investment. We have 300 homes any day of the month, any day of the week that we're managing for investors. And so back to your question, how does it evolve? We took it even a step further last year, and we combined our two funds. We used to have a rental fund and a flip fund. The rental fund was great because you participated in long-term home price appreciation that you saw in Bev's presentation that's steadily increasing year over year over year. And so you got to participate in that sort of compounding interest. The flip fund was great because we had these great cash-on-cash returns because we're moving homes every 120, 130 days. And you could get your capital out from the flip in a year, but in the rental, your capital was locked up for 5. So we decided to merge the funds, combine them, and offer our investors sort of a best of both worlds, if you will, where you can get your capital out on an annual basis, participate in the cash-on-cash returns generated from the flip and the rental income, participate in the long-term appreciation provided by now over 230 homes, and participate in depreciation in that in your on your K1. So it's come a long way in a relatively short amount of time. When you consider 15 million homes for rent in the United States,
Absolutely.
15 million. Less than 400,000 of those are owned by institutions. Blackstone's the largest landlord in the country, and they own 50,000. That's nothing. That means there's 14.5 million homes out there to buy, fix, and hold for rent.
It's a daunting number.
It's gigantic.
So I remember walking into the boiler room of that place. Alex Pure was my point man at the place. And I got in this argument with Alex about the value of a property and the way a file went down, and I walked in, and then I was like, holy crap. And the place looked like a trading floor. There's like 8 people. They're all sitting at the desk at the different trustee sales. They got double monitors like you're looking at Wall Street. You got everybody's in like an individual. How many employees, right? Like in 2012, how many employees do you have then?
Oh, we had over 50.
Yeah, and now it's down to what?
We're probably at 20 in San Juan Capistrano.
It's like a super lean property buying company with no bullshit, right?
No, there's no bullshit.
It was. I remember watching the guys on the phone because they got the bidders of the auction. And it was kind of bonkers to see like the way it all went down, and it was almost confusion where you're like just every property we could possibly get because the yields were always going to be there. When you guys decided to, well, basically when the yields left California. So by yields I mean the institutional investors were making a blended 6% yield, correct? So blended 6% yield, meaning they would buy a bunch of properties. All those properties they paid cash had to produce them a 6% return on their money they put in. So when they left, because I remember in acquisition we got to like a 4% place, and we're like, well, we're at the tail end of this acquisition. It wasn't penciling anymore. And you guys decided again to change because you moved with the market. How did you do? Did you sit at that table and you were part of that conversation of how it got there?
No.
Okay.
I'm not that smart.
I'm not that smart. But you were an investor, and I remember looking at the website, and it would say like we own 25 homes in our investor fund when they were buying all this stuff. So you came in as a fundraiser. What did that look like when they first brought you in versus today, like as a fundraiser?
So that's a long answer. So in 20...
We got 15 minutes.
15 minutes. So in 2014, I came on board, and we had just ended or closing out the relationship with Colony.
Yeah.
Okay. And so all of a sudden, we went from literally $20 million a month in capital coming in the door and bidding like on Wall Street
Yeah.
in a boiler room type situation, as fast as you can, as many as you can, to taking a huge step back and saying, okay, we're going to take all this experience and knowledge of what we've learned and what we can deliver to a colony and deliver it to an individual. And so, Jeff, as the CEO and founder of the company, when Colony and Goldman, like I said, when they're your boss, you don't have time to do anything else. And so he wanted a sales guy to come in and be able to not just raise capital, but service the investors and communicate with our current investors and partners and grow that business. So I was lucky to have been an investor with Jeff for a few years and have known Jeff for 20, and he asked me to come on board, and I couldn't get in the door fast enough.
Sweet.
Yeah. And so as an investor, I felt like, you know what, if I can, going back to my background of medical device sales, where I was working with cardiac surgeons and vascular surgeons in the operating room, I felt like if I could have this guy call me in the middle of the night to come help him save a patient whose aorta ruptured, I think I can talk to people about giving me some money and let me invest it for them wisely and safely and get a steady, dependable, conservative return for them. That'll be easy. I was wrong.
You were
not
wrong.
easy.
No, you see what you're saying? I'm like, well, it's not that easy.
It's not that easy.
So
not that easy.
There's a proper care and feeding of investors relationship that's sort of always ongoing. Everybody's different.
100%.
What was your biggest, so working with investors, what was your biggest, not hurdle, but biggest revelation working with a pool of investors and their needs?
Well, you're right. You hit it right on the head. Everyone's different. So we've got, 83 investors today. There's a handful of them that are what I'd call professional real estate investors, and they're experts already. They've forgotten more than I'm going to learn.
They just call and yell at you?
They just call me and tell me how smart Jeff is. but they do. They really know the market, the trends, the history, and what the opportunity is. What they want from me, a guy like me, is to shoot them straight and tell them, look, if I don't know, I'll find out and I'll get back to you. Where we're buying, I can tell them that. I can tell them how we do it. I can tell them, that this investment isn't, and this is where it really comes down to, is the relationship. This investment isn't about giving me, investing $100,000 and getting $8,000 back in return. It's about investing in an operation that that you like, and you get to meet Jeff, and you trust and admire what they're doing. You understand the real estate market. This is a really easy investment. And that's really what it comes down to as far as my job. My job's pretty easy from that standpoint.
So most people in this room will probably agree that they got into this real estate business, especially if they have retirement capital, because they wanted to get away from Wall Street, investing in stocks, which are kind of phantom and tangible, versus real estate's much more tangible. And you guys provide reports. I get your reports all the time, what you put out, which are a model for what kind of we're like, let's save these and copy them. They're doing a good job. I think you guys are doing a good job putting reports out. So how do you make an investor or help an investor, other than the chart, right? Just the math, really see what's going on in the company? Do you have other means of sort of being transparent?
Yeah, our experience with those institutions helped us a lot. We have a proprietary system that we built out through Salesforce for our investors, where they can actually log into their portal and see not just their capital account and how much money they've put in and what their return is and the paperwork that they've filled out, but they can literally go in and see every house that we own and what status it's in. Is it in construction? Is it on the market to sell? Is it on the market to lease? Is it leased? What's the rent? Pictures of the house, the address, obviously. We have an estimated section where we actually show our investors what we underwrote the property to, and then we have the actuals once it's leased or once it's sold. So now they can compare. You know, if we underwrote it to a $30,000 profit and we made 18, they see that. And that happens. And they see if we underwrote it to make 18 and we made 30, that happens. And they can see it. So we're not Merrill Lynch. We're very transparent. Another advantage is, we have guys, our partners can come into our office anytime. We have 73 of the 83 are in Southern California.
Oh, wow. They're really here.
So they're local. And we started this, as most people do, with friends and family. They can come into the office. They can see whatever they want. They get to meet Jeff. They can see our system. We take them on property tours. We had a couple from Australia just 2 weeks ago, and we took them down to San Diego. We took them through Orange County, and we walked the houses with them. So I think it's really unique and extraordinary what we do, but that's how it should be done.
No, I totally
as
agree.
an investor.
And it's live, right? It's live all the time.
Real time.
So, one of the things people like about an institutional style company is diversification, multiple deals, safety in numbers. And when they make an investment, they're sort of putting faith in management, not putting faith in an individual deal. Usually on smaller deals, especially when we're dealing one-on-one, you have a property, a note, the investor, the borrower. It's very close ties. Do you run into objections or difficulties where people they're sort of crossing that barrier? They're kind of saying, what am I secured by, even though it's a giant pool of properties?
Yeah, a little bit. So, the advantage to our limited partnership is we are more focused. We are far more focused on the right individual than the amount of money that someone brings in. We have a minimum, but the partner is paramount to the amount that they bring in. We are not interested in someone bringing $20 million in and telling us where to buy it, what paint to use. What
did that already?
We don't. Yeah, we worked with Colony. It was we don't want that. We want the individual partner, a passive investor that knows and likes real estate. And then, like I said, the investment isn't on the return. It's really the fact that Jeff, the CEO and founder, and his partner John, the operation that they run is, I just can't imagine anyone running a better operation than what we have. From analyzing it to disposing it, we're very fast, we're lean, we're efficient, we're not paying ourselves big salaries. There's no incentive for us other than to perform, because Jeff and myself and his partner we have 1/3 of the capital in our fund ourselves, so our interests are completely aligned with our investors. That's another really unique thing for a fund, right? We've got over $8 million of our own money right next to our investors.
Oh,
no preferential treatment, no one's subordinate to anyone. It's just the more money you put in, the more money you make. That's it.
So I want to kind of dig into your job now is essentially a expert in fundraising, right? Nobody ever becomes an expert. You just get better and better and better at meeting people. So and helping people get what they want. So a lot of people, medium level investors doing a couple deals a year. They're sort of trying to cross that bridge, right? Not institutional level, but how do you approach investors? What do you talk to them about? And I realize it's 100% about relationships after raising money, and it's the sort of same thing. But can you, especially because you came from medical sales and you had an abrupt change, can you kind of talk about what you learned in that first period about talking to investors? Is there advice you could give to somebody that was kind of new at that, wanted to raise private money, even small amounts?
Yeah, I think the biggest thing in sales after relationships is just being honest. If you can just deliver trustworthiness, build trust with your clients, the rest will come, right? So if someone asks you a question you don't know the answer to, don't fake it. Just tell them you don't know. If they want to know, I don't invest in anything unless it returns 20 IRR, 30% cash on cash. Don't tell them you can do that, because they're going to call the SEC. Those investments don't exist. So I think that's really, it's really simple. I really compare it to my medical background, where, a cardiac surgeon would call me in the middle of the night because his patient's aorta ruptured and he needed my help to save his life. If he asked me a question I didn't know, I wasn't going to tell him.
It's truly life or death.
Absolutely.
It's a good place to come from, because the results are so immediate. So where real estate, the results are a little delayed. If that kind of medical sales produces a very negative result quickly, you can see real estate sort of the same way. All right, I want to try and make this as useful as possible without going too high level.
Well, so back to your question though, if I didn't answer it well, the beginner.
Yeah.
It's hard. It's hard coming into this world of real estate, because there's so many things that I don't know. From a financial standpoint.
Well, so get into kind of that direction, right? So one of the things that I get asked all the time is, what kind of return does an investor want? Which is this very open-ended question. Now, I'm guessing in your experience, there's not one answer for that. Did you find that there were any sort of misnomers in promise of return or promise of transparency, or how you sold the product? Did you find there were like things that were just absolute turnoffs that people were like, nah, no, I'm out?
Yeah. Yes. The one thing I found early on, and it continues to be the same, is when I talk to a potential investor and they're asking me questions because they want to find out about us. It's really easy to learn about me and Pintar. It's not real easy to learn about an investor who's asking you the questions.
Yeah.
Right. So I always ask kind of the same thing over and over. What are you looking for? Mm-hmm. What type of risk do you like? Mm-hmm. What type of investments do you invest in? And I get very similar answers. I'm conservative. I want to preserve my capital first. That's my first and foremost. That's my second thought, third thought, and last thought. And then I'd like just a 6 or an 8% return. I'm really conservative. And then I ask, what are you invested in? And they start telling me how they're invested in foreign markets. Their cousin's brother told them what to do, and they had heard a great idea at a cocktail party, and none of it's conservative. None of it's what they just told me they wanted, and they're telling me they're getting double-digit returns every year. So that's the hardest part, is to sort of weave your way through the answers and present your opportunity in a real way. Yeah. It'd be great to say, yeah, we deliver 30%.
Sweet.
Right?
90%
awesome.
Leverage.
Beers on me. But you can't do that, right? Yeah. And so that's the hardest thing, is to really find out what each individual investor wants and expects.
So when we're raising money, or we have ours is 1-to-1, right? So ours is, we have a deal, it goes out to the world responds back. Now, what I found very interesting is, in an automated system, there's a certain number of investors that log in, and then there's a whole field of people that don't bother, which is weird on a one-on-one. Now, do you find that regardless of all the transparency, everything you put out on the web, all the tools, that you still need to call people all the time?
Absolutely. You can't. They have these investor platforms out there, right? You put your offering up and people can log in and read everything about it. Read that you worked with Colony, read that you've delivered this, and for 7 straight years. And they're not going to sign up and send you a check.
Absolutely.
It's not going to happen. They've got to get to know you, whether it's on the phone. I've had a few that I haven't met personally. It's not many. Most of them you've got to meet, see the whites of their eyes, let them. We have them to our office. Like I said, we're really open, and I think that's the key, because I can only raise as much money as well as Jeff and John run the operation.
Absolutely.
So I sell them.
Yeah.
It's not about me. It's about the operation and what they deliver. So if I can get them if I can get a potential investor in front of them, and they're really interested in it, it'll be a good fit for them because they'll see that they can trust these guys, that they're running an operation. They can vet them very easily. If Colony American Homes did it, then the individual investor can.
Absolutely.
I think get your head around it,
So I found that there's this weird relationship with my investors I developed after a while, where they really like you, and they really believe in what you're doing. And so one day I was talking to one, and he goes, "Why aren't you asking me for referrals?" And I was sort of blown away by this today. I'm like, I could do that? I didn't know I could do that. Do you get people that refer clients to you on a regular basis, and kind of what's that? How's that work typically? If they
So
do?
that's the number one way we raise money. But it's the best way to do it. A perfect example. My CPA is an investor. Was an investor before he was my CPA. He has brought in over $2.5 million into the fund.
That's a lot,
right? One guy, just by, that's a trusted consultant, right? They're meeting with their clients every year. They don't just come in and say, "Here's my receipts.
Yeah.
What do I get back?" They're asking them, "How do I save more money, make more money, invest more money," right? And so Brian doesn't just say, "Oh, put it all in Pintar."
Yeah.
He gives them his educated, his crystal ball of a few different options, and he always speaks of us kindly because we've performed for him.
Sure. Absolutely.
So that makes it, easy. A happy customer is a great customer, and he's going to bring you more.
No, absolutely. So one of the, you know what? I'm going to tell a story that I probably shouldn't tell, but I'm going to tell it anyway. So when we first started Rehab Loan Group, I think we told Jim already, so he'll be fine with this now. We had no money, but we started the company. Damn it, we're going to make money, and we put out our loan program, and we were like, "Oh crap, we got a loan to fund," and so we reached out and eventually we found somebody very close to us that was able to fund that deal. But it was like this 2-week sort of chicken with the head cut off, run around trying to find somebody to fund the deal. And that kind of happens in the beginning of funds. You're like, okay, I just made this huge commitment, now what? And investors want a track record. They always say, well, what have you done? What was your last year like? What was your year before like? You came in where the company had a track record from Colony. When you get asked for a track record now, what do you typically give an investor?
So our fund that's PICR Fund 3 is our combined fund that's been around for 1 year. So we've got a 1-year track record for that. This is our 6th quarter actually, but the historical 6 quarters isn't going to do it. But we had the flip fund from 2010 all the way until 2015. So we've got quarterly returns, and we've actually gone back and retrospectively done a monthly return on that capital. And we do it by investor and whether they receive their distribution or reinvest the distribution.
Okay.
So we get pretty granular with that. Then we have our rental fund from 2012 to 2015, same thing. So once we combined the funds, it was sort of easy for us to go back, okay, what if we would have had these two funds together forever?
Mm-hmm.
And frankly, the idea to do it was half of our investors were in both funds, so it seemed like an easy thing to do.
That's a good idea.
It was in simple math.
Is that why when I sat there during the presentation, we looked at each other like, yeah, of course?
Right.
Okay, that makes sense.
Right. So that's what we do. We give them numbers from 2012 to today.
Okay.
Right. So we're going back now 4 years, and so we quote 4 years consecutive double-digit cash-on-cash returns, and we can show them that monthly or quarterly, however they want it.
Do of the people you provide a background for, how many people would you say read that report?
Let's see. We've got 80 investors. I'm going to guess 6.
Do you find that weird?
Yes.
So, and I want to make that, and that we have the same experience.
Yes, it's bizarre because the average investor has $500,000 with us, and
Right.
77 of them aren't reading it.
But I want to highlight that because it has
Think about
everything
that.
with relationship.
Right.
And your track record, how they perceive you as a person, and almost nothing to do with the produced return. And maybe believing in what you do, which is really strange. I still can't figure that out. And now that brings up another question that we've run into here in this meeting and with our company. When you have a profitable company that has a track record, you wield a pretty big sword, right? Like you have the ability to destroy somebody's retirement, to make it amazing, and you absolutely have, a small fraction of people really, really reading, really looking into the reports. I haven't found an answer to this question, and that's the only reason I'm asking. Like, how do you tell the difference, right? I mean, we're giving transparency, you're giving transparency. There's lots of places giving transparency between a great fund, a great organization, and then all the people who are going to take your money. I mean, everybody puts on a good show, but have you found looking at other groups, there's red flags, be like, oh, I see exactly where they're messing up, even without looking at reporting? And I don't have an answer for this, is why I'm asking.
No, I haven't seen any competitor or other offering doing something out of the lines. I haven't seen that.
I only ask, I don't mean like actually seeing somebody do it, but
Yeah.
the reason I'm saying is there's sort of, so people come to us and say, I went and saw this, and this person took all my money and did this. And I couldn't tell someone this is the difference between us and them, because they're all sort of, like I said, nobody's reading the reports. And I've been struggling to figure out what the difference is. And I don't still know.
So does anybody watch American Greed?
Oh, it's a great
Only
show.
2, 3? That's my favorite show on TV. It's unbelievable. So you see these guys raise millions of dollars in a very short amount of time.
Yeah.
And steal it all.
Yeah.
It's amazing. And people ask me, how do I know you're not Bernie Madoff?
That's why I asked.
People ask me that. And there's a lot of answers I give. And it's really pretty simple, because buying a home, fixing a home, managing a home, maintaining that home, and then selling it or renting it, there's too many hands in that cookie jar for me to take someone's money and not put it to work. You could find it immediately. There's a title registered to the home when we buy it.
That's
you
a great
find
answer.
out that way, right? So Bernie Madoff, did you guys see the special on Bernie Madoff?
It's crazy.
He had $30 billion in a checking account, a savings account that no one knew about. He never bought or sold one stock. He should have been caught the second week he started doing this, right? But an investor gives me capital, gives it to Pintar. It's invested that day. It's spent, on average, in about 2.5 hours. So you can find that money is working right away. There's just two. Here's the biggest thing. Jeff Pintar, our CEO, personally guarantees every single mortgage that we have contracted on.
So what's interesting about what you said, though, is that because real estate is so transparent by default, right? All the parties, everything, and I've never had an answer for this. You actually gave me the answer I needed. Thanks for showing up. By default, real estate is transparent because it has to be. Because 10 people are getting fed in every transaction, and everybody's there to report you if you screw up. That makes total sense. Okay, well, I'll have an answer next time. Sorry, I told you guys I always abuse these interviews for what I need. That's what I did.
Well, I mean, it's a good thing to use, because people ask that all the time. It
Yeah,
comes
absolutely.
up every day. How do I know you're not that guy? How do we know this reporting? The other thing is, so yesterday I was reading an article. My daughter's soccer coach is a famous sports agent, and one of his clients got taken for $7 million yesterday. Well, it was reported yesterday by the SEC, and I sent him the story, and I'm like, how did this happen? And the guy so Brian was telling me how it happened, and it was as if he was telling me about an episode that I just saw on American Greed. It was the same damn thing. These guys get it. Now I don't know what reporting they have or anything like that. I do know that we have a third-party fund administrator. We have a third-party accountant that does our books. We have all of these 10 or 11 hands on that capital all the way through the sale. It would be very, very, very difficult, and I am not smart enough to figure out how to do it. But this guy must not have. There's just no way. If there's a third-party guy auditing your books or managing your funds and your reporting and your calculations, it's really hard to pull the wool over someone else's eye, right?
Okay.
And so, but this happened, and you see it on TV every night. Tonight they're doing another story on some guy who took $30 million. There's a guy who did $700 million in an insurance company in Minnesota. Did you guys see that one? I'm telling you, I'm addicted to the show. Sorry, I could talk about American Greed forever. It's unbelievable how this stuff happens. But if you are transparent and you can just show them these reports and show them that it is another company doing it, it's not just Kevin and Jeff telling you that, hey, it's a 10% cash return.
Sure.
Right? That's a big thing, and that gives you instant credibility and increases your relationship.
No, absolutely. Matter of fact, when we started, it was, hey, we got this deal. You're going to get a deed of trust. You're going to get this hypothecation document. It's going to be attached to this property. You get it at the end. And then we were noticing that we were starting incurring costs. So we're like, okay, we're going to have this third-party reporting cost. We're going to have this inspection cost. And I struggled, actually. I remember arguing with Todd, like, we can't pass this cost on the borrower. We can't pass it on the partner. This is going to be a real problem. And then we started looking at it and realizing how valuable a physical inspection cost of a property is by a third party, a processor doing your transactions to third party, an auditor by your own CPA, and so on and so on. And the third party cost ended up being like an investment. It was literally an investment in the future of your company.
Absolutely.
And even on anybody who's like has deals on a one-on-one transaction where it's just you have a deed of trust, you have a property you're buying. If you have a third party inspector to tell your construction cost, if you have really anybody who's a fiduciary at all, look at the numbers and make sure it pencils. If you have a broker of some sort, make sure the note is legal. You have title and escrow. That's 5 people in the transaction, and those 5 people all verified it. It's almost an investment in your deal. So even if it affects your return, it's worth every single penny because they'll tell the next person, the next person, the next person, and so on. Now, I had an investor tell me recently, I had like 3 of them tell me that we could give out their phone numbers for referrals, say, as a reference. Have you had that experience? You do that internally?
We don't. We have an advisory board. So we've got like 4 guys that have sizable investments with us that have been with us for 3.5 years on average. That's about right. Yeah. So they sit down with us once a quarter and kind of make sure we're not drinking our own Kool-Aid too much, right? But they also have volunteered their time to meet with prospective investors, whether that, it doesn't matter the size of the investment. It's just if they want to speak to someone who's in the fund and has been and can speak to their report, how they receive the reports and how long they've done it. That's a big advantage.
Did you have an advisory board when you first started selling for them?
No.
When did you get the advisory board?
July of last year.
What did you see as the change with the advisory board versus before?
So, we feel like we needed it because when we merged the funds, our headline on our PPM is to raise $75 million in equity. It's an evergreen fund, so we're not going to close it, and we want to take it to $200, $300, $400, $500 million.
Sure.
To get there, we had to get a third-party fund administrator. We had to get an outside accounting firm. We had to register with the SEC. We had to have, we felt like, an advisory board of some high-level investors, and also it's sort of like a board.
Sure.
A board of directors, right? One of the guys wasn't an investor. He has since become an investor. We had to have that. We don't want to. I think investors typically don't want to give their name and number out and talk about their own money and
It's
where
only
they
like
put
3
it.
people out of all
Yeah,
of them.
no,
yeah.
that's
It's a very small number.
yeah. So instead of going to them and saying, "Hey, Brian, could I give your number out to the next guy I talk to?" Even if he's an accountant, we didn't want to do that.
Sure.
Right? So what we did is we created the board and asked them to join us as an advisory role and sort of made it more of a consultative role as opposed to reference. Does that make sense?
Yeah, absolutely. So is there a little more of like a tighter feedback loop now where there's sort of you have management, right? And they're running it and they're smart. That's why the fund's doing well. And then you get into quarterly meeting to get sort of punched a little bit like, hey, did you think about this?
Yeah, and so what they'll do is, we'll have our presentation, our pitch book, and it's been changed, you can imagine, 100
Sure.
times in the last month. But they change it all the time. And then it's great because they give you an investor's perspective. We don't need these eye charts on returns or data points from every single zip code in Southern California. It's really just what is the simple stuff. And they've helped us keep it simple.
As you become more effective in the process.
For sure. Instead of, I remember when I started 2 years ago, I think our pitch book was 78 pages.
Oh my God, that's huge.
We got it down to 39.
Yeah, I'm like, ours started at like 32, and I was like, this is kind of beefy. We got it down to like 15 to clean it up.
Yeah, Jeff would like it about 60, but I'm trying to get it about 20.
Yeah, it needs to be really quick because I remember I had our first meeting, and I sat here and I sort of steamrolled this guy, and I think it was like 22 slides at the time or something, and on slide 4 he was interested. But I was so like green, I'm like, and then the next one, and if you'll just wait, and he's like, just where do I write the check? Like he was done. He's like, just send me the deal. And at some point once they're in. If they like what you're doing. And so yeah, it's almost like the shorter the better. If you can get the simple is hard, right?
Oh, 1 page is ideal.
Yeah.
Right?
That was a common question we didn't get until we got into the mid-market. Send me a 1-pager. What the hell is a 1-pager? So we tried to do one of those. I think it looked really stupid in the beginning. It's gotten better over time.
I've got some 1-pagers in the back for anyone interested.
So you brought some here.
I brought some 1-pagers.
I'm going to steal your example. I'm going to take it with me. I try and type as much stuff as I can from multiple people in the industry.
We are great cloners.
I love it. I didn't totally steal it, but I definitely took some pointers from the buy sheet that Colony had, where they you filled in the blank across the top and it gave you your yield at the end. I think got a little overzealous at the end of the spreadsheet, but
we still have that.
Do you still use it?
Yeah.
I remember I got the first one for flip from Alex. He's like, "Here's our flip spreadsheet." I'm like, "I need 8 lines. You don't need all this crap. There's 8 lines in mine." And I'm like, "This pencils." And I sent it back to him. That's funny.
Yeah.
So let's see. We got 16 minutes.
Let
me ask some questions. Anyone got any questions? I know this is kind of a little higher level than normal. What's the minimum investment?
So the the historic double-digit return is a 10.89% cash-on-cash return. We don't do IRRs. We do a cash-on-cash return, and there is an unrealized gain that we report every quarter as well, because as you saw in Bev's presentation, these homes are appreciating every month and every year, and that's about conservatively a 3 to 5% per year on top of that.
Ooh, actually, that reminds me of another question.
And the minimum is at the discretion of the general partner. So for someone coming off the street, we tell them it's $500,000, and if you get to know Jeff or Kevin, then it's at our discretion.
Creeps down. So that reminded me of the question I get all the time about funds. Now you guys aren't Colony, but I mean you run a decent sized fund. What do you have any? How are you determining your exits on rental properties? Like when you're going to exit or sell?
So we have no plans to sell.
I agree with you.
At
I'm just
all.
wondering if you,
Yeah.
if you do it.
We have sold rental assets over the years. It's typically when the property comes up for releasing.
Okay.
And we look at it and we say, okay, we've owned this house since 2012. It's appreciated X. If we sold it, the market value today, we could deliver, I'm just going to pick a number here, $100,000 in profits to our investors, or we could rent it, maybe raise it 10%. 10's crazy, I'm sorry. 7% is what we raised it last year. 7% we raised the rent and deliver that to our investors. So it's sort of a, okay, where are we, right? Do we want to sell it and deliver it? Most of the time, in fact, every time we ask ourselves that, it's a yes.
So is it more if it's a D class property, or is it more to ensure that you get a decent return for the investor, or is it both?
So we don't have any D class properties.
Okay. Well, what I meant D was, I don't like that one. We should get rid of it.
Right.
For example, that property's in Hammond. It's really far, and the taxes suck in that neighborhood, and it's affecting the yield. Something
Good point.
like that.
Yeah, right. So it's a case by case basis.
Okay.
We're not big enough to where we can't look at it one by one. I mean,
Absolutely.
we buy these homes one by one. We walk every home before we buy it.
I know.
We
It
don't-
took forever.
We don't buy it off the internet. We don't buy it off someone's quote. We don't buy it off a picture. We're actually walking the properties. Yes, sir. I'm sorry.
What you got, Duncan? So are the rental properties without any mortgages? Are you using leverage?
We do use leverage. We buy them for cash. After they're rented for 90 days, we put debt on them, one by one. And our documents allow us to go to 60% of market value on those. We're today at about 42% leverage. We'll never get to 60 in our fund because 45% of our homes are for flip, and we're turning those in less than 130 days.
Questions.
Follow up.
A couple other questions on those. Properties that you look at to purchase for rentals, are they single story? Do you kind of limit yourself to some criteria like a single story, like 3-bedroom, 2-bath? If they're built, I don't buy anything that's that was built after or built before 1979, just to avoid the lead-based paint and asbestos issues. Mellow roofs issues. You look at all those. Could you just kind of go through some of that?
Yeah, that's a good question. So we buy predominantly for our rental portfolio out here in the Inland Empire. It is the rule is 3-bedroom, 2-bath, approximately 2,000 feet, right, plus or minus. We're buying today. Our average price is about $185,000 for the rental.
Is it still 1960 plus?
1970 plus, I would
70 plus.
say. Yeah. The advantage though is that those homes haven't been touched since, right? So we buy them in some sort of disrepair. We put some good money into it, on average 10 to 12% per home, and when we rent it, it's like a model home. So take that 1978, 1988 home that hasn't been touched in 30 years plus. We're buying it for $180 in cash. 90 days later, we're putting leverage on it. Does that answer your question?
Yeah.
What's the typical discount that you buy at? Average, I say.
Yeah, that's a great question. So we today feel like we're buying dollars for 70 cents. This is not 2009, 10, 11, and 12 where we were getting them for 50 cents. The homes that we're buying for $185,000 out here in 2007 were almost double that, right? So we're moving towards getting closer to that number.
Is it still yield based?
Yeah, for the rentals, yeah. So
Yes.
we're getting, I think it's a 9.6 gross, right, before the leverage. So we're getting, the way we've set up our fund is Jeff and I are very, very conservative. So we sort of plan for the worst first. If the shit hits the fan tomorrow, we rent everything out in our portfolio and we'll deliver our investors a 6% return. The return will be cut in half, but they'll get a 6. They're not going to go to 0 and they're not going to lose capital. But the homes that we have in our portfolio rented today will deliver our investors a 6% net of fees. You asked, there was a second part to your question. Could you say that again? Did I answer it? I did? Okay. Okay. Thank you.
There's a lot of companies that started buying one-offs in 2009. What do you think separated you guys and it allowed you to get a fund and work for Goldman and Colonial versus, you know, the guy who's still buying one-off at the trustee sale?
I wasn't real clear. Todd, did you get a better story of my life?
You know, so back in 2009, there was you know, a lot of investors buying, and you know, maybe they had a small office, and today they still have a small office. What do you think allowed you guys to, you know, get in the bigger leagues and start doing some, like raising a fund and these other things?
Okay, so the short answer is the experience. Partnering with Colony and Goldman and Beazer was very challenging and very rewarding from a fee base. They weren't investors and we didn't participate in profits with them, but they paid us a lot of money to operate for them. And that helped us scale this whole thing. So the individual investor that's buying a home sees that it needs new floors, new kitchen, new bathroom, and let's just say it's costing him 10% of the purchase price. So he's buying a home for $350,000 and he's going to put 35 into it. His 35 is not going to get that job done. Ours will. We're able to buy at, you know, we're not buying retail, right? We're buying significantly less. It's probably 50% less than what an individual investor would be able to buy the flooring, the appliances, the bathroom, all of it, construction, maintenance, all of it. And that's because of the scale that we're at.
You know, from the like boots on the ground side, because you guys are employing all the agents, the one thing I noticed when I was doing acquisition for Pintar was, and you'll see this for all the funds, when they were sending out a proof of funds, an offer, whatever they sent out, there wasn't even competition at all. Todd experienced this when I liquidated some properties for Todd. When we would get an offer from, let's say, all 3 of the major competitors at once, and there were 40 other offers, everybody else just got ignored. Because the security closing was so high, you knew one of them were going to go, and like they just outstepped everyone on that nature alone.
So I guess I'm asking, you know, how does Goldman, and I'm guessing they're in New York somewhere, how do they know to contact you guys to buy for them and operate the buying business versus, you know, I mean, did you run an ad on the Wall Street Journal? Like, you know, what was it that linked, you know, you guys and some of these other companies to buy for them?
Yeah, so they you know, they came out to California to start buying homes in huge numbers, to take that pool of homes public, right? Securitize those loans and take it public. They found us by coming to California and finding out who's operating in these markets. And we've been here since 2009. Now they came out in 2012 and 13.
Yeah.
So we've been doing this for a few years now. We'd already bought thousands of homes on our own, whether it's at the county court steps and also for rent. So, you know, but the vetting process, you know, when Goldman Sachs comes into your house and wants to check the books, you've got to have it in line, right? And so that putting our best foot forward with them propelled us to where we are today. Does that make sense?
Kirk in the back.
Thank you. So I have a question about how you choose between the rentals and the flips. Is that predetermined when you kind of have identified the address or found it, or is that kind of after you do the walkthrough, you make that decision?
It's the short answer is we know it before we buy it, and it's really price. So we're buying rentals for $185,000 on average. We're buying our flips for less than $420 on average, and so you can't buy a $420,000 house, put 10% into it, and then rent it out for $1,500 a month. That doesn't pencil, right?
So is the short answer, if it pencils the rental, you keep it. If it doesn't, you flip it?
It does, and there are, as you know, there's exceptions to every rule. We've actually turned some flips into rentals. They're few and far between, but it can work in some markets.
Kirk? All right, so are auctions still the best way to buy for you guys? You still buying trustee sales? That's your best acquisition method?
No, it's not, for us. It's not.
Never was, right?
No, I mean, so back in the heyday when that was all that was going on,
Yeah.
right? But now it's changed. Sorry.
City? Yeah. The trustee sale. Yes.
Yeah, so it happens. It's rare today. The prices have gone up from that. So, we were talking earlier about the kind of the boots on the ground perspective, and we have over these years developed lots of relationships with a lot of different brokers and agents, buyers, contractors. Everyone out here knows that Pintar is buying homes, can close today in cash. And so we've got people sourcing deals for us every day, people calling Alex with deals.
Yeah.
And then we have 3 asset managers today. We just hired our 4th. So in a few months, he'll be up and going. But these 3 guys have been buying homes for rent and now for flip for us since the days of Colony and Goldman, when they were buying hundreds in a week, to now we look at hundreds in a week, but we don't pick it unless it fits the pro forma. And that's $185,000 for the rent, on average about $1,500 a month in rent, and it's got to fit, right? We can't buy something that we've got to redevelop or spend too much money rehabbing. It's got to be in a good neighborhood. It's got to be near good schools. It's got to have good jobs. Our average tenant makes north of $80,000 a year. So we're not buying, in slums, and we're not renting to just anyone. We have quality renters in model type homes that stay with us for 3 years on average. We're raising our rents every year. We're, Goldman and Colony and these guys that came and institutionalized this market helped us participate in that as well. 15 million homes for rent, 14.5 of those are owned by individual investors. I'd say 99% of those people do not raise their rents on their tenants annually.
And I feel like they, despite everybody complaining, because I remember the complaint about, the institutional guys are buying everything. I felt like the institutional guys sort of legitimized buying and holding rentals in bulk as a business model. And so you could essentially copycat what they do and then just mimic it forward forever.
And the market is such that it's not going anywhere. There's a housing shortage in the United States. There's far many more people than there are houses.
Yeah.
Population's growing 3 million people a year. There's been no new home construction in the United States since 2007 and 8. Of those homes that are being built, none of them are being built 400,000 and under. None of them.
No,
Right.
they're all trying to build 3,000 plus on a 5,000 square foot lot to maximize return.
Bev, you had a stat tonight. There were the average home in Orange County tonight was 700,000, 710. That's existing, right?
Median existing, yeah. Median MLS existing.
You know what the new home price costs in Orange County now? $1 million. It's over 1 million. So this population that's growing 3 million a year, the 85 million millennials that are out there that have student loan debt that are making on average less than $50,000 a year, that have that can't make the savings. They're 12 years away from saving, and the median price in America, which is under 300, I think, they're never going to buy, especially in Orange County. So people are going to Rivers, coming here.
Yeah.
Right? It's affordable. You get a great home. It's great schools. It's a great life. So you're an hour from the beach. It's fantastic. You get to come to the Mission Inn. That's what's happening, and that's what we're building this business on. It's a fundamental. There's just not enough houses for the people.
Yeah, and when you combine that with pushing the peak spending years of the echo boomers into like the mid 2020s, you're just gearing up for an amazing boom in real estate. Yeah, as soon as they start building stuff again, right?
Right. And they're a long way from that.
Right. Is there any more questions? You got one more? Couple more?
So the Jeff, you said in 2009 he founded the company. Was this his first cycle? And also on the debt that you guys have on the rentals, can you tell us, what the rate is, or is it amortizing? What if there's a balloon? How long the balloon is out? The debt on the debt on the rentals that you guys have.
So I heard the second question, the debt on the rentals, the rate. So today we have it at 3 3/4. That's an adjustable rate, and we're right now shopping for permanent debt. We think that's the biggest sort of risk we have in our fund and to our investors, is not having permanent debt should another global crisis hit.
So you're literally copying exactly what Colony did after you finished acquisition. It's
Exactly.
the same thing. Yeah. Okay.
Yeah, we're very good cloners.
Yeah.
But what was your first question? Sorry, I didn't understand.
It was about if this was Jeff Pintar's first cycle.
Cycle? So no. Jeff's background is commercial real estate, and he was with CB, ran the Pacific region out of Sydney, Australia for a few years. Prior to that, he was a broker in San Diego. After leaving CB, he was at Panattoni. Carl Panattoni's commercial company was the largest privately held commercial real estate company.
CB Richard Ellis, right?
So CB Richard Ellis,
Just
yeah.
so
Sorry,
so
CB Richard
jargon,
Ellis.
jargon flag.
Sorry. So Carl, they were buying shopping centers all over the country. And when 2008 crisis hit, they had north of $200 million in loans came due like that.
Yep.
And so Jeff and Carl and their partners worked their way out of it. The sort of learning for us, for Jeff, now us, is that Carl and his investors bought shopping centers one at a time.
Mm-hmm.
So let's say we were all partners in this, and I owned a shopping center, you owned a shopping center, you owned a shopping center, you owned a shopping center. When the market did this, you lost, you got half your money back, you got some back, I got all back. And we thought, Carl said, well, if we would have had a fund, we could have all shared in the risk. Our profits may be less, but our risk would be far less. And so that's where the idea was, to have a fund, aggregate a portfolio of homes that deliver strong cash returns, that mitigate risk out amongst the portfolio. So if one slab leaks, or 10 homes go unrented, or 3 stay on the market in the flip longer than our 60-day average, we'll be okay. We'll be okay.
I think we got time for one more.
Yeah, I do one more. I'm gonna getting towards it's 9:20.
I understand what you said about the relationships on the investors, and like the minimum being like $500,000 and at your discretion. But for a startup investment company, when we're going out, can you give some tips as to how we identify the right people for the investment? I mean, does the first investor I get the highest dollar set the minimum, or is 50,000 too little for me to start pulling together? Just some clarification when we're starting out and we don't have that track record.
I think there's no such thing as too little. truly. I have, you know, I started for half the minimum in 2012. The key is the partner. It really is. And I say that from experience because, you know, when you get someone to trust you with their money, you've got to perform on that. And most investors out there don't want to just go all in right off the bat. They'll stick their toe in the water and make sure you know what you're doing and see how it goes. But the real investor, if you choose the right one, if you do perform for them and you are transparent and you do all the right things, they're going to add to that investment. And more importantly, they're going to introduce you to new investors.
Yep.
And I think that's really the key. So we say our minimum is $500,000, but if someone walks up to me for 10 times less and I get to know them and like them and they like me, then we're going to put their money to work. And I think you should, I would do the same again if I was starting over.
Yeah, there's absolutely no minimum with new people because we've experienced it. I'm sure you've felt the same. Oh, I only have 50,000, and then later on they show up with $1 million, right? So keep in mind your discretion has more to do with whether or not you like the person. The safest thing to do is ask, would I work with this person for the rest of my life? And if the answer is no, don't take their money. If the answer is yes, then take it.
Sure.
All right, guys, we're gonna wrap it up. Stick around. All right, so if anybody's got additional questions, Kevin will kind of wander around the room, come pick his brain.
You gonna stick around for a little bit, Kevin?
Yes, sir.
All right. All right, everybody. Well, that's the end. So we're gonna break to the presidential lounge, and you're free to stick around here for a little bit. But be sure to exchange those business cards, and we'll see you again next month. Thanks for coming out.
Take it easy, guys.